The greatest threat to the global economy has never been an imminent military conflict, a fleeting tech bubble, or the political noise echoing through the halls of the White House. It is something so profoundly boring that you have likely never heard of it, unless you have spent considerable time diving deep into the darker rabbit holes of global finance. And that, precisely, is why everyone ignores it. While the world watches in awe as artificial intelligence leaps forward, and oil prices swing wildly, and politicians trade barbs, a silent earthquake is slowly building in a place almost no one is looking. If you have ever wondered why mortgage rates refuse to come down despite every promise made, or why markets erupt into sudden panic every few months without warning, or why the financial system feels perpetually uneasy despite all the central bank talk of rate cuts, the answer does not begin in Washington. It begins in Tokyo. To understand what is truly happening, we need to travel back to the early 1990s, when Japan's great asset bubble burst and shattered everything the country had built through decades of discipline and sacrifice. Real estate and the stock market collapsed simultaneously, and Japan entered what became known as the Lost Decades, 30 years during which time froze economically, with no real growth, no inflation, and no rise in wages. Imagine buying an apartment for $1 million in 1990, then waking up 20 years later to find it worth $400,000, your salary unchanged, and grocery prices the same, or lower. That is the reality the average Japanese citizen lived through for a generation. Like walking on a treadmill for 30 years and never moving an inch forward. In a desperate attempt to break this stagnation, the Bank of Japan did what central banks do when conventional options run dry. It cut interest rates to zero, then below zero. Then it went further still, engineering what is known as yield curve control, a technical mechanism that essentially nailed interest rates to the floor with extraordinary force and prevented them from rising, regardless of circumstances. Imagine a friend offering you a loan at 0% interest. In fact, paying you a small fee simply for agreeing to borrow from him. That is what borrowing in Japanese yen cost for years on end. It sounds generous on the surface, but it was quietly generating a problem of far greater depth. This reality created a painful dilemma for Japanese investors, pension funds, major banks, insurance companies, sitting on trillions of dollars with nowhere profitable to put them at home. So they went looking abroad, embarking on the largest financial shopping expedition in modern history. Japan became the single largest foreign holder of U.S. Treasury bonds and the biggest creditor in the world. Think of it this way. If your savings account pays you 0 interest, you wire the money somewhere that pays 5%. That is what Japan did with hundreds of billions of dollars for decades, quietly transforming itself into a giant ATM that bankrolled the entire world without fanfare. From this reality was born one of the most dangerous financial instruments of the modern era, the yen carry trade. The mechanics are deceptively simple. Borrow in Japanese yen at near 0 interest, convert the funds into dollars or euros, invest in U.S. treasuries or tech stocks, or real estate in emerging markets that offer far higher returns, and pocket the difference with minimal apparent effort. Imagine borrowing $1 million from your neighbor at 1% interest, and depositing it in a bank that pays you 5%. You earn 4%, essentially for free, as long as your neighbor keeps his rate low. That is exactly what global investors did with the yen for years, and because this trade runs into the trillions, the Japanese yen became the hidden fuel powering the engine of global liquidity. The entire world was running on free Japanese Wi-Fi, and almost nobody noticed. If this is the first time you are hearing about any of this, you are not alone. And that is exactly the problem. Most financial media ignores stories like this one because they do not generate clicks, cannot be condensed into a provocative headline, and will never trend on social media. But the real threats are never the loud ones. If you want to understand money at this level, not just headlines, but the actual machinery underneath, subscribe to History of Money. This is precisely the kind of story we exist to tell. The slow-moving forces that shape your financial reality long before anyone else is paying attention. The entire carry trade rested on a single fragile assumption, that Japan's interest rates would remain at zero forever. In 2024, that assumption broke. The Bank of Japan raised interest rates for the first time in 17 years, and the ground shook beneath global markets. Japan's Nikkei index suffered its largest single-day collapse in decades, and the shockwave rolled across New York, Europe, and Asia simultaneously. The reason is simple at its core. Free money was no longer free. Return to the neighbor who lent you money at 1%. He suddenly raises it to 4%. The spread you were earning has vanished, and you are forced to return the borrowed funds immediately to avoid losses. Now picture millions of investors around the world doing this at the exact same moment, each one frantically selling assets and repatriating money back to Japan. This is what is known as an unwind, and it is precisely what triggers those sudden, seemingly inexplicable market panics that leave analysts scrambling for explanations. This reveals the deeper dimension of the problem. Many people believe the U.S. Federal Reserve controls everything, and that a rate cut will automatically translate into cheaper mortgages and easier credit. But the reality is far more complicated. The Fed controls short-term interest rates only. The rates that determine your mortgage, your company's borrowing costs, and the value of long-term assets are set by the laws of supply and demand in the bond market. The United States needs to borrow astronomical sums every year to finance its growing deficit. When the reliable Japanese buyer, who for decades purchased those bonds steadily and without hesitation, begins to step back, yields must rise to attract new buyers, and that rise translates directly into the higher mortgage payment you make every single month. Imagine selling your house, and the one buyer who always showed up without negotiating suddenly disappears. To attract anyone else, you either drop the price or offer better terms. In the bond market, better terms mean higher interest. And that higher interest is what you pay on your home loan, your car, your business. We are living through a historical inflection point in which the architecture of global money is being rebuilt from the foundation. The cheapest source of liquidity the modern world has ever known is drying up. The backbone that supported global markets for 3 decades is quietly fracturing. Companies that grew accustomed to cheap borrowing will face an uncomfortable reckoning. Investors who assumed that liquidity was a permanent feature of the landscape will discover that the oxygen has been slowly leaving the room. What makes this so dangerous is not its complexity. It is its invisibility. Traditional media ignores it because it offers no drama, no villain, no single moment of crisis to broadcast. Who wants to discuss yield curves and carry trade mechanics when they could be covering the latest AI model or political scandal? But the most consequential threats have never been the noisy ones filling the headlines. They are the ones sitting quietly in the forgotten corners of international balance sheets, growing in silence until they reach a size that can no longer be ignored. History has made one thing unmistakably clear. The stability of the global economy over the past 3 decades was not built on the brilliance of Wall Street investors or the wisdom of Washington policymakers. It was built, in no small part, on the quiet patience of savers in Tokyo and their willingness to finance the world at near zero cost. When that long silence finally decides to speak, the world must listen carefully, because the price of continued indifference will be steeper than almost anyone has imagined. In the great game of money, it is never the storm you can see that sinks the ship. It is the small crack that everyone agreed was not worth fixing.